The biggest tech stocks were major drivers of the market rally in the first half of 2023, but things did take a downturn for many of them in the third quarter. Here's how far they're off their highs of the year. If you take a look at things, Tesla off by about 16%. You've got Microsoft down by just over 13%. Similar for Nvidia. Amazon off by about 13%. Apple same. Meta down 7.8% and Alphabet down by about 5.8%. Joining us right now for an exclusive look at technology and the venture capital landscape is Ann Winblad. She is Winblad's Venture Partners co-founder and managing partner. And let's just talk about things, because I always think of you as somebody who does bottoms-up work. You are looking at companies, you're looking at private companies, publicly held companies, and you're judging those companies on what you think their success likelihood is. At a time like this, where things have changed and the outlook overall, interest rates are up, the Fed, do you actually pay attention to some of those changing factors too when you start thinking about where you put your money?
Well, it's really hard to ignore them. Our job is to be optimists. We really have to look at the glass as half full and find opportunities. So it's important for us at the same time to realize that we're not immune to the same headwinds as the customers of these companies. So we are providing market value, and market value is priced to value and priced at how the customers will pay. So when there are headwinds for the customers, there are headwinds for the companies. But at the same time, we really look to find opportunities to deliver value. And that's probably why these companies that you're now calling the Magnificent Seven are doing so well year to date, maybe not just in September, is that they're delivering extraordinary value to customers. And that's what we're looking for.
Does that value proposition, is it a lot tougher given the gains they've seen year to date? Is it a lot tougher given the interest rate situation? Do you see fewer opportunities now than you did a year ago, or is that just not the case because there's new stuff popping up everywhere?
I think there are more opportunities. I'm on a university board, I'm on a foundation board, so I live outside of the tech world occasionally. And I see how hard technology is for people to really use. So this AI boom is really real in that it delivers much more productivity. We're seeing that in the DevOps for developers. One of our companies recently did a poll of 800 developers in major corporations. 97% of them are using generative AI. And they are also able to quantify that on average, they're saving 6 to 8 hours of work week time by using these new generative AI tools. And we're going to see that bubble up into the productivity tools as well. So AI penetrating these companies is not new for us as investors. We have to invest at the almost bleeding edge when we do early stage investing, which is what our funds do. So I do see more opportunity. The expansion of technology into space tech is another example. Doing experiments at the microgravity level, doing different data observation. We're really seeing quite a few new opportunities. It'll take time to build new companies from scratch, but the existing companies that are embracing these technologies in the right places are delivering extraordinary new value.
How big of a limiting factor is just, the talent factor, having AI-trained engineers and computer programmers who can do that?
That is always, talent is, these companies are about people. They're not really about capital. So people make the difference here. And you see, like in major sports, that major people are traded between companies. We have been seeing in the last month that the job boards are increasing in job openings for enterprise software companies as well. So that means we're going to be entering a new war for talent. So it's a big deal. We're not graduating enough engineers. It's a real specialty. It means that you're not just a computer programmer, but you're a data scientist. And then at the low level, you can just merely be a prompt engineer.
Can I just ask a question about all, the companies we just listed on that you would imagine be the beneficiaries of this? I wonder if all this AI technology ultimately becomes a commodity, and that ultimately it's just built into all of these companies, and it's almost defensive for them from a market share perspective to have that technology. Not that it necessarily, if everyone has similar stuff, how it fundamentally changes. I understand how it could change employment in other businesses that use these technologies, and maybe that gives all these companies the opportunity to charge more over time. But if it really actually works like that?
Well, it's this next week in Denmark, they're celebrating the 25th anniversary of Bluetooth. That's just present everywhere. You can't imagine going in your car without using Bluetooth.
So who was the beneficiary, though, of Bluetooth?
Well, Bluetooth was developed by 7 founders and goes to a .org, so effectively it's just patent profits there. But things do become ubiquitous. Right now, it really is the companies. Let's use Microsoft as an example. They have 47% of the productivity market, 325 million paid users of those productivity apps. Some of those are really hard to use. I'm an expert Excel user, but I hate doing PowerPoint. It's hard for me. Well, with Copilot, it's suddenly easy with the AI stuff. I'm a developer. Who benefits from that? GitHub. That's a big beneficiary. Over time, some of this benefit might become less valuable. Can Microsoft now charge $30 a user for the Copilot? Probably. Just the same as OpenAI can charge me $20 a month to use the current stuff versus the old stuff. But I do think that over time it becomes an ingredient, but it also does transform things. Things are built from scratch with this as a core technology versus just a co-pilot.